Hi everyone, a very warm welcome all our viewers. This is the first webinar that we are doing for a very long time. Today the topic is navigating the US presidential election, which is coming up in about 1 week time. This is going to be a very short webinar. We hope to end by 8 p.m. The agenda is quite light in nature, but the topics itself quite heavy. Let me first share a little bit more about myself for those viewers who may not know me that well. My name is Tai Zhi. I'm the CIO of AutoWealth. I spent more than 12 years in the industry, starting off with the Sovereign Wealth Fund GIC and a hedge fund, and lastly, family fund before I co-started AutoWealth together with Noel Lee, my other co-founder. Today, I'm also the vice chairman of the SAFRA Investment Committee, which oversees more than 100 million US dollars of financial reserves. I'm also a board member of the NUS Alumni Advisory Board, as well as the NUS Business School Alumni Association. Without further ado, let us kickstart proper by first looking at the election timeline. We are now about 6 days away from election day, which is 3rd of November. If the results are decisive, we are going to have a president-elect exactly 1 week from today, 4th of November. That said, with an election that is administered across 50 states and more than 100 million voters and decentralized election rules, there's a possibility we may not have a clear winner on 4th of November until sometime later. Let us understand how the US presidential election works. This is a graphic of the 2016 election. In each of the 50 states, the candidates which wins the state popular vote wins a group of political party loyalists called the electors, who would then cast their electoral votes for the candidate. The electoral system distributes power across the 50 states according to the Congress representation, i.e. to say, one elector vote for each Senate and House representative seat. The exception is Washington, D.C., with the 3 minimum electoral votes, despite having no senator or House representation. 48 of the 50 states adopt a winner-take-all rule. If you win, for example, Florida, you win all the electoral votes of Florida. The exception is Maine and Nebraska, which on the other hand, allocates 1 electoral vote to the winner in each district within the state, and 1 electoral vote to the overall statewide winner. The candidate who receives at least 270 electoral votes, i.e. to say, an absolute majority, would win the election. This is what a Trump victory may mean for financial markets. From a policy perspective, Trump prioritized the economy at the risk of COVID. He supports cutting capital gains tax from 23.8% to 15%. He also supports reducing red tapes to prevent stifling economic activity. He espouses American first protectionism, buy American, hire American, which means the oil and gas industry and domestic jobs are likely to stay supported. And we cannot rule out Trump at this point, given the complexity of the electoral college system. Trump surprised many by winning the 2016 election with 304 electoral votes, even though he lost the popular vote by more than 3 million. In contrast, Hillary Clinton only garnered 227 votes. This is what a Biden win may mean for financial markets. From a policy perspective, Biden prioritized fighting COVID over the economy. Biden is likely to reverse the 2017 Trump tax cuts, increase corporate tax from 21% to 28%, raise income tax for the top income earners, and raise the minimum wage to US dollars 15 an hour. A Hoover Institute study estimates household consumption will likely decline 7% if Biden wins. Bank of America estimates S&P 500 corporate earnings will decline 9.2% on average, with tech, communication services, and consumer discretionary companies leading the earnings decline. At the last presidential election debate, Biden affirmed he would transition from the oil industry. He also supports expanding healthcare, child, and educare. While Biden's campaign policies may sound fundamentally negative for US equity markets, the possibility of a blue wave Democratic sweep of the Senate and the White House could mean more ambitious government spending and fiscal stimulus, which could otherwise be blocked by the current Republican-controlled Senate. Remember, the House is concurrently carrying out its own election for all seats, and the Senate is concurrently carrying out its own election for 1/3 of the Senate seats. The Democrats stand a chance to gain control of the House and the Senate. Now that we have established a Trump win or a Biden win may both be fundamentally positive, let's analyze empirically the market impact of all US presidential elections over the last 30 years. If you see the left side of the chart, US stocks were randomly volatile pre-election. The right side of the chart shows US stocks generally appreciating post-election, plausibly due to market optimism over a renewed or new administration. This market optimism creates an opportunity for easy gains over the following 8 weeks post-election before tapering off. So, what's the downside risk for financial markets? The election results may be too close to call. This controversy last occurred in the 2000 US presidential election. Bush's winning margin dwindled to just 300 votes when the mandatory machine recount was completed. Al Gore then requested for a hand recount in 4 counties, which is allowed under the state law of Florida. The hand recount was carried out over the following few weeks. Finally, on 12 December, the US Supreme Court, in a 5-4 majority vote, reversed the Florida Supreme Court's previous recount ruling, and it reversed it back for modifications on the constitutional principle that all votes must be treated equal. With only 2 hours left to meet the legal deadline for appointing the state electors, the recount was effectively ceased, and Bush won Florida with only 537 votes, as last certified on 26 November. His winning margin was only 0.009%. That was how close. It was notable that Bush won the election despite losing to Al Gore by more than 543,895 popular votes. If the too close to call election results in 2000 was complicated enough, the 2020 election could be worse due to the complexity of mail-in votes. 9 states and Washington, D.C. allow mail-in votes automatically. 34 states do not require an excuse or allow voters to cite coronavirus risk as an excuse to cast mail-in votes. 7 states require excuses beyond coronavirus risk to cast mail-in votes. So as you can see, each state has its own rules. Pennsylvania and Wisconsin, both swing states, they are regularly hotly contested. They can't start processing or counting mail-in votes until election day. And the Pennsylvania Supreme Court ruled that officials can only count mail-in votes that arrive up to 3 days after election day, provided they are postmarked by 8 p.m. on election day, 3rd November. The US Supreme Court was split in a 4-4 vote, which then let the Pennsylvania Supreme Court ruling stand. But let's bear in mind, a newly appointed Justice Barrett may well tilt this ruling. There's also potential complexity where the state governors and the state legislature may submit potentially conflicting state results if the win margin are too close to call. The swing states of Pennsylvania, Michigan, Wisconsin, and North Carolina all have Democrat governors but Republican-controlled legislatures. Under the Electoral Count Act of 1887, the newly sworn-in Congress, House, and Senate will separately decide which group of submitted electors to accept in case of such conflicting results. And let's remember, The House is currently controlled by the Democrats, whilst the Senate is controlled by Republicans. So it is not entirely clear what happens if the two chambers cannot agree. If you think that's complicated enough, more complexity is possible with faithless electors who may potentially not cast their electoral votes for the party's candidate. 7 faithless electors have did so in the 2016 election. There are no federal law or constitutional statute that binds an elector's votes. 38 states and Washington, D.C. have state laws that bind electors to vote for the popular vote winner, while 12 states doesn't have such a rule. The final complexity can occur if no candidate receives at least 270 electoral votes. The election would then move to a contingent election. In a contingent election, the party with the most representatives in each of the 50 states will cast one vote in the House for the presidential candidate, and each senator would cast one vote for the vice president. The contingent election is complicated by the fact that the House is concurrently carrying out its elections for all 435 seats, and the Senate is concurrently carrying out elections for 1/3 of its Senate seats. In the event the House does not produce an absolute majority, the vice president, which is voted by the Senate, would become the acting president under the Presidential Succession Act of 1947 until the House eventually decides on a president winner. Okay, rational investors, what should we do? We should therefore capitalize on the opportunity, but mitigate these risks by only committing your investments if Trump wins by at least 270 electoral votes. Given that Trump has signaled he may challenge the election results if Biden wins, and given the many lawsuits that his campaign have already filed over the election procedures, investors may want to wait for Trump to publicly concede if Biden is announced as the president-elect. Or otherwise, you may want to wait for a US Supreme Court ruling on any legal challenge that is filed by the Trump campaign. Lastly, I want to caveat, whatever election insights that we have shared today, they are intended to improve your odds and make good investment decisions. Having a good starting hand in poker makes you win most of the time. However, a good starting hand does not necessarily guarantee you will win every single time. Along the same lines, good investment decisions make you profitable most of the time. However, good investment decisions do not necessarily guarantee you would be profitable every single time. With that, I've come to the end of today's webinar. You may now ask me anything over the next 10 minutes through the webinar's Q&A option. Okay, so let me start with the first question by Mr. Tan. Mr. Tan mentioned that my monthly DCA, dollar cost averaging, is on the first day of the month. Should I wait and see? Now, let us first understand this from a rational perspective. As an investor, right, it is very rational for you to commit monthly DCA in a very disciplined fashion. Okay, and when you look at your investments, you want to look at them long term. Okay, so if you already have a dollar cost averaging plan in place, there's really no need to adjust anything. After all, you are looking at a very long run. The timing of investing when a clear result is being announced and undisputed is applicable for investors who have idle money that is really sitting on the sidelines and waiting to commit them and take advantage of the opportunity. Okay, and these are short-term opportunities. Okay, so if you belong to the rational discipline group, there's really no need to do anything. Okay, let me move on to the second question by Joseph. Joseph asks, can you reiterate when to buy with regards to Trump or Biden win? If on the 4th of November, the results are decisively clear that Trump has won at least 270 electoral votes, then you should go into the market as soon as possible. because Biden have openly said that he would not, like Trump, challenge the results in court. Trump has signaled that if Biden wins, he is going to challenge this result in court because of the many electoral procedures which are very controversial in nature. Okay, so if Trump wins at least 270 votes, this is the time you want to go in. If Biden were to win, we need to wait for Trump to concede defeat, okay, or otherwise to wait for a US Supreme Court ruling on the election results. For the 2000 election, it took the court many weeks before it finally ruled that Florida was in favor of Bush, which then gave Bush enough electoral votes to win the overall election. The third question by an anonymous attendee: will you update us? This is the green light, time to pump in the idle cash. Yes, do watch out for our social media. It is quite impossible for us to individually message our existing users because, as you know, we have like thousands and thousands of users. So do watch out for our social media. Later on, before we end, I will share which are our social media links that you can join. For example, you can like us on Facebook, you can follow us on Instagram, you can also join our Telegram community or subscribe to our YouTube channel. Okay, let me move on to the next question. How much do you recommend pumping in, assuming I have 30,000 sitting around? If you have, let's say, 100% of funds idling around, no matter what's the absolute amount, let's say it's 10,000, 20,000 or 30,000, pump in about 1/3 at any point of time, okay, to take advantage of such tactical opportunities. Okay, the reason why I say 1/3 is because you want to keep aside another 2/3 in case there are further market discounts that you can go in to take advantage of. If you follow our social media and if you join our Telegram, you will see that I always recommend the same thing. Put in one tranche when there is a substantial market discount, and we always say that a substantial market discount is quantified by 5% from the prevailing peak. Commit another 1/3 of your funds when the market discount hits 10%, and then commit the last 1/3 when the market discount hits 15%. So along the same logic, I would say that in this presidential election, whatever amount you have sitting idle, commit 1/3 of them and keep 2/3 just in case there is any more market discounts to take advantage of. Okay, I'll move on to the next question. This attendee asks, valuation is still high and the COVID situation in US is entering another peak phase. Should we buy just based on the election outcome? The same logic that the previous question would apply. Commit only 1/3 so that you have some idle funds in case there is some other factors in the market that drives a further market discount for you to take advantage of. Let me also address where our valuations is. When we first rebound from the COVID, which was sometime in 23rd of March this year, analysts all across all major banks and stockbroking houses, they have adjusted their earnings outlook for the companies. They have adjusted it quite drastically. Now, I have shared this in our social media before. The earnings per share estimate for the MSCI All Country World Index, which is around 500 over points, the earnings per share is about 118. If you look at the earnings per share at 118, right at the bottom of the market, today, these earnings per share have rebounded from 118 to about 130 plus, which means to say the economic rebound has happened and the company's earnings have also rebounded, which brings our valuation back down to a more rational level. So if you look at the major market indices based on the next 1 year of earnings, the market index is not overvalued. There is really no need to worry about valuations. And let me also remind everyone that these earnings upgrades will continue to take place across the next few months as the companies continue to deliver their results and show that they have bottomed out from this impact. Anonymous attendee asks, will our respective wealth manager alert us buying into the market? So I have shared earlier on, We have thousands and thousands of users, so please bear with us. It is going to be very challenging for our wealth managers to message you guys individually one by one. So the best way is to keep a lookout on our social media. Later on, before we end, I will share again which are our social media channels. Okay, next question. Either Trump or Biden win, tech stocks are relatively safe. What do you think? First of all, if we look at the technology stocks, earnings have went up in general. And you can see that the tech stocks earnings are more defensive to COVID. And if you look at the tech stocks valuations, they are trading at about 30 over times forward 1 year earnings. 30 over times means presuming each year the tech stocks earn about $1 in earnings over the next 1 year, you are paying about 30 over dollars just to buy the tech stocks. That also means you need to wait about 30 over years before you recover your capital back. That's quite a rational level in our opinion. It is nowhere near the 100 times price earnings ratio that we've seen during the dot-com bubble. Okay, let me move on to the next question by Gabriel. So Gabriel asks, should I be worried about FX since the Federal Reserve is printing money non-stop and the US dollars will likely depreciate? This is how the Forex market works. The supply of money does affect Forex rates. However, let us bear in mind that the money supply is not the only factor in town. There are many more other factors that influence the FX rate. So if you look at, for example, the USD SGD rate, right, you will notice that it generally hovers between 1.30 to about 1.40. And sometime earlier this year and also sometime last year, we went beyond 1.40 all the way up to about 1.45 before it came down back again. Let's remember that the Federal Reserve has actually increased money supply by very sizable amounts, okay, trillions of dollars. Why haven't the USD SGD rate come down to the lower end of the range, which is 1.30? Why is it currently still hovering at about 1.36? Now, the reason is very simple. Whenever there are market risks, for example, you have a COVID second wave, you have questions over whether the White House and the House of Representatives, the Democrats, which is controlled by the Democrats, whether they can agree on the next economic stimulus package. Because of all these market risks, people tend to seek some safe haven assets. And when they buy US government bonds, actually what they have also done is to demand US dollars, because all the US government bonds are denominated in US dollars. And we all know that the US government bonds is one of the strongest safe haven assets in the world. We also need to factor in this safe haven demand, which is driving US dollars up. Okay, so there are many factors in play, and generally that's the reason why our current exchange rate is about 1.36 and has not went down to the lower end of the range, which is about 1.30. I would say that in general, do not be overly concerned about the USD SGD rate. If you look at where USD SGD was 3 years or 5 years ago, we are generally about the same level. Bearing in mind that US dollars and SGD, they are all major currency pairs, they tend to stay relatively stable. Next question by Joseph. During the 2000 election, from D+1, the first day after election, to D+365 is basically negative, okay, which means it is not advisable to pump in idle cash. Why do you think that this will not happen again? Let us remember that the 2000 election, right, was a unique case because there is the dot-com bubble at the market backdrop. This is the reason why the markets could have went down instead of going up. If you strip out the 2000 election and you strip out the 2008 election, which is affected by the 2008 Great Recession, the rest of the presidential elections across the last 30 years, they tend to generally appreciate post-elections. Another anonymous attendee asks, what would be the procedure to pump money in? Would there be any updates from myself or Ray when to transfer the money to my account? So I have answered this before. Watch out our social media. It is impossible for us to message you guys one by one. And what is the procedure to pump the money in? Log into your account, click deposit funds, and then follow the simple set of instructions. Funding instructions is all available when you log in to the AutoWealth account. We still have more questions, but unfortunately it's coming to 8:01. So what I'll do is to answer 3 last questions before we end today. Anonymous attendee asks, should I be more prudent given COVID is still around? Yes, you ought to be more prudent. This is the reason why in the earlier question, I advised that if you, whatever idle funds that you have, commit about 1/3 of them in when the election outcomes are clear. Reserve another 2/3 in case the second wave of COVID, drives more market discount. You at least have some funds to take advantage of the market discount. Second last question by Gabriel. Do you think there will be a bubble or another crash like the one in March? Bubble? No. From a valuation perspective, none of the markets that we invest in, US, Europe, Asia Pacific, and emerging markets, and even if you look at the industries like tech, none of them are in a bubble state right now. So there's no bubble to talk about. About another crash like the one in March, right? Let's say we have COVID second wave, which is worse than the first wave. Now, that could potentially happen, but will the markets crash as much as what we've seen in March? I doubt so. If you analyze all the market cycles and the booms and busts of equity markets, you will realize that the first time markets encounter a situation, it is totally unprepared. This is the reason why everybody panic sell, just like what happened in February and March of this year. But once you have that memory in mind and you know what has happened and how much markets have declined, you generally are more mentally prepared, and markets are more mentally prepared. So this means that the second time the same thing happened, okay, markets are not going to decline that much. You can take reference from the Euro debt crisis, which happens in 2 waves. The first wave in May of 2010, and then the second wave 1 year later in 2011. You will notice that the second wave was less drastic than the first wave, simply because markets were already mentally prepared for such events to reoccur again. Now really coming to the last question by another anonymous attendee. Could you share which industries or sectors will benefit from a Trump versus a Biden win? For example, oil and gas, will they benefit from a Trump win, while clean energy for Biden? Yes, you have got it spot on. I shared earlier on in terms of their policy perspective, what they have promised during their campaigns. Trump is very concerned about American jobs and American first protectionism. So this means that Trump is not going to care about your Paris Accord. In fact, it withdrew the US from the Paris Accord, and it cares more about oil and gas jobs that are in Texas, in Ohio, Pennsylvania, so and so forth. Oil and gas are likely to benefit if Trump wins. Biden wins, the contrary will happen. The clean energy companies will benefit more, and the oil and gas will likely be negatively affected. Other sectors or industries, now there's really not many industries that are specifically affected by the election campaign, except for oil and gas, the one that is more clear. Another one could be the financial sector. As you all know, the Democrats, generally their policy is towards more corporate governance, whereas the Republicans is more towards deregulations. If Biden were to win, this could spell more regulations for the financial industry, which can hamper the way how they can produce more profits. With that, I have come to the end. I have promised to share our social media. Here is our 4 major social media. The first one is our YouTube channel, where we host short videos, including today's session. We would also host it on the YouTube channel. To get the call when to pump in your idle funds, if election results are clear, do watch out for the remaining 3 social medias, which is join our Telegram community. Just search for the word AutoWealth. The second one is to follow our Instagram. And the last one is to like or follow our Facebook. Please help us to improve our webinars, scan the QR code and give us your feedback. With that, we have already come to the end. We look forward to seeing you at our next webinar. Thanks and see you.